Hello, I'm Midan Wu from the American Stock Exchange University, March 31st. Let's start today's American Stock News. We welcome the unwavering spirit of American stock investors maintained by Midan Wu. It's the last day of March, and March 2025 was a month that stock investors would rather not remember. But fortunately, today is the last day. We hope that the upcoming month of April will show a more positive trend in the United States stock market than March did. There are various graphs on the screen right now, and among them, there is one at the bottom called Average Percentage Change of All Months. What is this? It's a summary of the past history from 1928 to 2025. So we calculated the average amount the United States stock market would rise or fall each month from these numbers. March is generally not a good month. Of course, if you look at the average now, it did rise by 0.6%, but compared to other months, it was a slightly weaker month, you could say. On the other hand, starting from tomorrow in April, a new month begins and it rose by an average of 1.32%. This figure is the second best in a year. The best performance was in July, with an average increase of 1.7%, and after July, the best month in a year is April. So now with the start of spring in April, and perhaps in the United States market as well, as the spring breeze blows, wouldn't there be quite a few good things happening, thus raising our expectations? Well then, let's start today's Big Two news on March 31st. Before we proceed with the broadcast in earnest today, there are two important announcements that I think need to be delivered. First of all, the first one. Tomorrow is the first day of April, and unfortunately, I think I will have to make the first decision on the first day of April. Suddenly, I have to visit London for some reason. I'm sorry, but I will take a day off for the broadcast on April 1st. And there is another important announcement to make. I made an announcement on the community tab on YouTube an hour ago. We are holding a free ebook event for our premium members and subscribers. Recently, I appeared on a major channel called Hawaii Representative, and many of you have watched the interview video and gave me very positive feedback. I appeared on this channel and conducted an interview summarizing my philosophy and strategy on various investments that appear in the book, The Truth of United States Stock Investment, that I recently wrote. Since so many people like this content, I decided to make it into an ebook and distribute it to everyone. As shown here, there is a period for applying for free ebook distribution. You need to apply from today until the night of April 3rd. And it's not first come, first served. Everyone who applies will be scheduled to receive the ebook on April 4th. The application process is very simple. As you can see, there is an application link here. If you click here, you will be directed to a simple questionnaire application form. If you fill in your situation in the space provided here and apply, everyone will be until April 4th. The essence of United States stock investment, I think you can get this book as an ebook, which contains various contents in this book. And after reading this summary, if you think the content is really good, it would be nice to purchase the book, The Essence of United States Stock Investment, that I personally edited this time through the online bookstore or ebook purchase link, and read the whole content. Well, everyone, I hope many of you will take this summary and ebook, which are distributed for free this time. This broadcast summarizes United States stock market fluctuations over the past week. More to come. First, if you look at the S&P 500 map, I've changed the period to a week. Overall, you can see stocks that have risen here and there. However, even then, the tech stocks we are concerned about, even among them, when a very poor trend was detected mainly in semiconductors, all three major indices had no choice but to fall. You'll see if you look at it this way. Especially last Friday, it took a direct hit. If you set the period to 1 day, you can see that the very clear red color is covering the market overall. So I tried to spread out a bit over a week, but as the market crashed, the United States stock market recorded a minus in all sectors. You can see it like this. If you actually look at the results of the past 5 days, the microcap, the very small stocks, have fallen by 33%. The Nasdaq 100 fell by 2.47% and the S&P 500 fell by 1.48%, showing a downward trend in the overall market. The scores of all 11 sectors in the S&P 500 show the same trend. Technology was the worst performer, dropping 3.54%. Second worst was communication services, which includes Google and Meta, down 1.91%, followed by industrials, down 1.59%, and healthcare, down 1.42%. If you look at the bottom, you can see that consumer staples was the only sector to record a plus, making it the only one of the 11 sectors to rise. So, with 10 sectors falling in unison, the market breadth of the S&P 500 dropped sharply. 33, 59, you know. Therefore, currently, over 66% of the 500 major companies that make up the S&P 500 are showing a downward trend, which is a very bad momentum that is being observed. Next is the volatility index. There was a time when we were expecting the volatility index to break below the 200-day moving average and go down. Unfortunately, as you can see, it bounced back from the 200-day line and now it has hit 23.95. If the volatility index exceeds 23, the market atmosphere is dangerous. We can make such a judgment. Now, once again, if the volatility index rises sharply, the market cannot show a stable movement. You will see it like this. So the fear and greed index would have fallen. There was a time when it went up to the fear level. Now it's down to 22, and the extreme fear is once again dominating the market. Next is the market score provided by Chosista. The market score is still normal. It's about 46. Those of you who watched the broadcast of Representative Kim In-jung last week may know, but Representative Kim In-jung is not yet at the stage of selling stocks until this support level falls to the distribution stage, and we are evaluating it this way. Here are the final scores from our last discussion topic. On Monday and Friday, when the stock price fell a lot, all of our top picks, except for one category, recorded a minus. Celestica was the worst with a minus 13.82%. The second worst was Cred Technology with minus 12.58, Broadcom with minus 11.76, Enode Data with minus 10.59, Bistra with minus 8.83, Talon Energy with minus 8.07, and Nvidia with minus 6.82. Taiwan Semiconductor was minus 6.50, Alphabet was minus 5.89, Palantir was minus 5.62, and MicroStrategy was minus 4.80. Bitcoin also dropped 4.28% to 8,145. 4.07%, 3.27%, 2.53%, 1.78%, and 1.32%, with most stocks showing a decrease. Last week, Tesla was the only one to record a plus, with a rise of 5.97%, the only stock to show an upward trend. What was the decline rate of the United States stock market last week? In fact, most of it was made in one day on Friday. For example, in the case of Nasdaq futures, it showed a very unfavorable trend by plummeting 27% in just one day on Friday. Well, then let's start by examining the reason why the atmosphere of the United States stock market suddenly became dangerous last Friday. As many of you already know, last Friday, a really important economic indicator was announced. It's the personal consumption expenditure that we're familiar with. Personal consumption expenditure is an abbreviation for personal consumption expenditure, which we usually call personal consumption spending. The reason this report is important is because it's the most indicative on an annual basis. It's the content of the report we trust. You can think of it this way. The table here is neatly organized. If you look at the top, the PC index is now month over month, comparing with last month, 0.3%. The PC price index has increased compared to last month. You can think of it this way. The market's expectation was also 0.3%. And if you look at the bottom, the PC index is now year over year, comparing with last year. It has increased by 2.5%. This also matched the expectation. There was no problem up to here. But the important thing is the more important core PC here in the core PC. The food product with extremely high volatility and excluding energy, recalculating it again. This is the most trusted, most dependent economic indicator on an annual basis. You'll see it this way. But this is important, what we call the base PC. This core PC index has risen by 0.4% compared to last month. And it exceeded the market expectation of 0.3%. And even compared to last year, the core PC index has risen by 2.8%, while the market expectation was 2.7%. Therefore, the inflation fears have slightly increased because the most important price index was a bit higher than the market expectations. Even if it's not now, the tax hasn't been applied in earnest yet, right? The scariest reason for the tax is the high possibility that inflation will accelerate again in the future, and the market has such expectations. But even before the impact of the tax is actually felt, the PC prices are already going up. It's finally over. There's a sense of dread among investors that inflation will rise too much in the future, and if you look at it this way, it's quite scary. Well, but that's not all. There was another problem. Now, if you look down here, it says real consumer spending, right? Consumer means consumer, and it's talking about consumer spending. The fact that real is attached in front means that it's adjusted for inflation. So it's adjusted consumer spending. Compared to last month, it went up by 0.1%. But the problem is the market believed that there would be about 0.3% more spending, so consumer spending was significantly less than expected. So inflation continues as expected and consumer spending has actually decreased. So what does this mean? The worst case scenario we fear the most is approaching. Inflation is rising as expected, and we call the phenomenon where the economy is stagnating as it is stagflation. So in the PC report that was announced last Friday, therefore, the PC report released last Friday made many investors feel the possibility of stagflation coming, and as a result, many investors thought they couldn't stand it anymore. They had to throw all their stocks. I think it's understandable in this way. In such a situation, Goldman Sachs, one of the major institutions in the United States, updated their opinion. I will summarize what they are talking about in this article. They are predicting an increase in inflation, a slowdown in growth, and an increased risk of economic recession. The title alone has a negative tone, doesn't it? However, I will summarize again at the end, but I personally don't think this forecast of Goldman Sachs is that bad. This week, following the decision on President Trump's latest tariff, Goldman Sachs is coming up. It is pessimistically predicted that the external environment can raise inflation and unemployment rate and almost stagnate economic growth by imposing aggressive tariffs. Investors are now predicting that the tariff will rise to 15%. That's the general consensus. If President Trump announces higher tariffs on Wednesday, the previous risk scenario appears more likely. So we're heading into a situation where the risk is significantly larger, making negative predictions, but only time will tell. If you take into account foreign products and countries, in the end, they point out that the increase in the index will decrease by 9% on average. Global Investment Research Manager An Ha-Chu is coming out. We continue to believe that there is a greater risk for market participants due to the tax on April 1st than previously assumed. Therefore, the investment risk for the tariff to be announced this time is much greater than expected. We are presenting a pessimistic view. First of all, regarding inflation, Goldman Sachs predicts that core inflation, excluding food and energy prices, will rise to as much as 3.5% by 2025, thus conveying a negative opinion. If that happens, this is because the previous estimate was 3.0, so it will rise by an additional 0.5%, and this can be understood as such a prediction. As many of you know, the annual target rate is 2.0. If it's significantly higher, it's not good, as seen in the expectation presented this time. If the result is that inflation rises like this, the possibility of economic growth rate weakening is also high. The first quarter growth rate, when calculated annually, is 0.2%, and the annual growth rate is 1%. Well, what does this annual rate here mean? It means that the market expects the first quarter growth rate to be extremely low. Why? Because when we calculate gross domestic product income is extremely important. Why? Because after deducting expenses from income, whether it's consumer spending, investment, or government spending, it all adds up. But in the first quarter, there was a tremendous amount of income because many income earners increased their income by a large margin because they said they would raise taxes. This is the first quarter of 2025. So the growth rate of the economy will be extremely low. Adding 4 here is exactly the rate, so if you calculate the first quarter growth rate annually, it's extremely low. It's nearly 0.2%, correct? And from 2024 to the fourth quarter of 2025, when we look at a year, we expect about 1% growth. Therefore, it is possible to understand that the economic growth rate has significantly increased due to the current inflation. And the fact that the annual growth rate is 1% is a downward adjustment of as much as 0.5%, because the previous expectation that Goldman Sachs had was 1.5%, so you can see it this way. Goldman Sachs also predicts the unemployment rate will climb to 4.5%. This forecast also dropped by 0.3% from the last time. They previously predicted it would stay around 4.2%, but that's not the case. They predict the unemployment rate will quickly climb to 4.5%, a pessimistic forecast. Goldman Sachs, when considering such predictions, stated that the probability of a recession occurring in the next 12 months has increased from the previous prediction of 20% to 35%. The likelihood of a recession has risen sharply from 20% to 35%, sounding pessimistic. However, despite this, 35% is not necessarily a high figure. Therefore, I personally think it's better to consider that the probability of avoiding a recession or not encountering a recession is still a whopping 65%, which is significantly higher. Well, next is a forecast related to interest rate hikes. Economists at Goldman Sachs do not expect this to be the case this time. We discussed stagflation earlier. Goldman Sachs expects the likelihood of stagflation to be very low. In fact, Goldman Sachs is predicting that the annual interest rate will be lowered 3 times this year. Can they really lower the rate 3 times? Inflation is not such a big risk. It's just being exaggerated like this. This is a step up from the previous prediction, which expected 2 decreases of 0.25% each. The current point forecast also predicts that there will be about 2 rate cuts this year, and this is the prediction being conveyed. On top of that, Goldman Sachs predicts that there could be about 1 more additional cut. Goldman Sachs economists have moved forward the Fed's dot plot of a rate cut in 2026 to 2025, and as a result, they predict 3 consecutive rate cuts in July, September, and November of this year. Let's summarize in one word from the Federal Reserve. The forecast of Goldman Sachs featured in this article is actually pessimistic, as I interpret it. First of all, Goldman Sachs is predicting that the probability of a recession occurring over the next 12 months will increase from the previously anticipated 20% to 35%. What if the probability of a recession exceeds 35%? It could be interpreted that the United States stock market will avoid a bear market where it continues to fall more than 20%, and this downturn will end as a correction. Of course, it's already fallen about 10% now, but there's a possibility it could fall an additional 15%, 16%, or 14% from here. However, even then, a bear market usually occurs when a recession occurs, or if not, when a gold interest rate cycle appears. So, if Goldman Sachs' prediction is correct, that is, a 35% chance means there's a 35% chance of entering a bear market. So it can be interpreted negatively. Now, what else do Goldman Sachs' economists say? They predict 3 consecutive interest rate hikes in July, September, and November this year, right? If the annual interest rate hike is confirmed, the possibility of the United States stock market returning to a bull market from then on is high. Don't bet on the annual. There's such a thing. The annual lowering the interest rate ultimately means to trust the annual and invest in the bull market. It can be interpreted this way. Therefore, this can also be interpreted as this downturn is not a bear market but a correction market. As I've often said, historically, United States stock market corrections usually recover their peak in an average of just 4 months. Therefore, if the prediction I made this time about Goldman Sachs is correct, it means that the bear market is not coming. Furthermore, if the Fed can only cut rates 3 times by 2025, then ultimately, even this time, it will not be a bear market, but will end with a correction. If that happens, the bottom will typically recover in about 4 months, and it seems possible to maintain such a positive mindset. The futures of the United States stock market displayed on the screen look incredibly gloomy. The S&P 500 has fallen by 1.13%, and in the case of Nasdaq, the futures index is currently plummeting by an additional 1.34%, Well, there's a reason why the atmosphere has been bad since Monday, and it's thanks to President Trump once again. President Trump made another statement on Sunday, causing the futures market to tumble on Monday. This is the content of the article. Let's take a look at what he said this time. The futures of the United States stock market are falling after President Trump said he is not at all concerned about raising prices, even if foreign car manufacturers impose additional taxes, in anticipation of the broad new tariffs scheduled for this week. He doesn't care at all. If the price of foreign cars goes up, it will lead to buying American cars, President Trump said in an interview with Munhua Broadcasting Corporation News on Saturday. I would like it if prices went up, because then people would buy American-made cars, he said, adding that there are plenty of American-made cars, which is a very blunt statement when you think about it. A new 25% tariff on foreign-made cars and car parts? The higher tariffs on imports from more of America's trading partners, announced by President Trump, are expected to take effect the day after April 2nd, which is next Thursday. So there are a lot of significant events happening this week, among them the higher tariffs on April 2nd, and then another set of tariffs, a 25% tariff on cars, is expected to take effect on April 3rd. In short, that's your perspective. And another thing, last week the higher tariffs were more limited than expected, and they will become less burdensome, so there's some anticipation rising about that. Last January, the Wall Street Journal reported pessimistic news that the Trump administration is considering imposing high tariffs of up to 20% on almost all United States trade partners. President Trump is also talking about Air Force One in January. Inside the plane he himself is flying in. He confirmed once again to the reporters that he will start imposing high tariffs on all countries. Thanks to that, the gift tax is now falling sharply, and if you look at it this way, it will do. Bitcoin is also plummeting, falling below $8,200. Well, there's a lot of uncertainty about the rate of price increases due to Trump's tariffs, and if you look at the personal consumption expenditure report released last week, inflation is extremely severe. Moreover, disappointing economic indicators are being released monthly, shaking the confidence of investors. Therefore, there is growing concern about stagflation, where the rate of price increases is high and the growth rate is stagnating. This is how it can be summarized. In an interview with Munhua Broadcasting Corporation News, Trump reportedly criticized the content reported by Wall Street Journal last week. He warned American car companies not to raise prices due to tariffs, and there were reports of this content which he denied. Trump says this, "No, I never said that. People are starting to buy American-made cars, so whether they raise prices or not, I don't care at all." He revealed like this. The White House spokesman later revealed that President Trump mentioned a price increase for foreign-made cars like this in detail. In this regard, I personally think that Trump needs some restraint. I'm not good at making political comments on air, but personally I think it's a bit over the top. Whether he became a diplomat, a congressman, or a president, I think it's inappropriate for a public servant. After all, it's the people who appoint public servants, right? Therefore, I think it's right to lead that group in the direction the people want. I've been wondering lately how many of the current American citizens would approve of Trump's policies like this. What I mean by that is, whether the price goes up or down, I don't care. It would be nice if they didn't sell imports from abroad. That's what he's saying. Well, do American consumers only want to buy American cars? That's not the case. People in America want to buy Korean cars. And Toyota, and not just that, they want to drive good cars imported from Europe, like Benz or BMW. But is it right that Trump, a public servant, has the power to single-handedly block such rights? I would like to express a somewhat negative opinion. Anyway, economists and analysts, it's debatable whether American car manufacturers can avoid price increases. Especially as many imported car parts become the target of tariffs, American car manufacturers, in the end, will have no choice but to raise prices due to the increase in part prices. Uncertainty is being fueled. Especially analysts in Morgan Stanley predict that car prices can rise from an average of 11% to 12% to offset the cost of tariffs. Even if Trump can convince car manufacturers to keep prices stable, it will have a negative impact on the company's profits. Either raise the price or reduce the profit, one of the two. Therefore, this will have a really negative impact on the auto industry. Why? Because even if it's not necessarily so, there's a high possibility that it will put a lot of pressure on the very low margin, as clearly seen in the automotive industry. In the weekend memo, SPI's asset management Steel Inners says, let's think realistically. United States car prices are rising, demand and supply are freezing, so consumers, if prices keep rising, they won't buy cars as much as before. This is definitely moving according to the law of supply and demand. In a Saturday interview, Trump said he plans to maintain the new tariffs aggressively. He said so. The tariffs on Mexico and Canada have been postponed, but the tariffs scheduled for April 2nd are very unlikely to be postponed, he said. There is a willingness to negotiate only in cases where other countries are trying to provide us with great value. Therefore, I reiterated my firm intention not to compromise. By this point, it is necessary for the American people to slowly form an opinion and put pressure on Trump. As I mentioned earlier, public servants are people who work for the citizens. It would be great if a clear message could be delivered to President Trump, who is working for them, about what the current American citizens want. And I personally hope that President Trump would clarify his position and his issues for a moment. Well, it seems that the Trump administration issue is getting worse as it goes on. So at this point, I plan to deliver a special content that could be helpful to you all, and I would like to share one of the most important clues in the current situation. Many of you probably vividly remember the 2022 bear market that had been predicted. The cause of the bear market at that time was incredibly simple. It was a cycle of interest rate hikes triggered by the continuous inflation. At that time, the United States Federal Reserve had been conducting a very long cycle of interest rate hikes. Starting in March 2022, it went on for almost a year and a half until July 2023. Yes, as shown here, they raised interest rates very frequently over a very long period of time. At first it was March 2022, and then May, June, July, September, November, December, and even into 2023, February, March, 2022, May, July. They relentlessly raised interest rates without a break, so the bear market had no choice but to come, you see. In 2024, they finally changed their policy to lower interest rates. The first time the United States Federal Reserve lowered interest rates in 2024 was on September 18, 2024. This way, we can sort out the situation of interest rate increases and decreases during that time. Well, I want to point out a very important clue here. Due to the continued interest rate hikes from March 2022 to July 2023, what about the United States stock market? The S&P 500 dropped up to 25% consecutively in a bear market. So at what point during the period from 1 to 12 above was the bottom of the last bear market? This is today's quiz. Let me show you again. So it shows a continuous rise in gold prices from 1 to 12, and now it starts to decline. So where was the bottom of the United States stock market among these? So as you can see here, the gold price keeps rising up to 11. So when it was around July, did the United States stock market hit the bottom in July 2023? Or did it finally hit the bottom when the United States Federal Reserve decided the first interest rate in 2024? This is today's quiz. Of course, many of you know the answer. As you can see here, the bottom was right here. When was this, you ask? It was October 12th, 2022. Now, October 12th, 2022 has a very significant meaning. Let's go back and take a look. If it's October 2022, it's between October 12th, 2022 and 6th. Now, the message I want to convey to all of you is right here. This is where an important investment lesson is discovered. October 12th, 2022 marks the midpoint in the interest rate cycle of the past fiscal year. In this way, the stock market always reflects the real economy and the speculative situation. It's incredibly difficult to determine that period, almost impossible. That's why it's often said that it's difficult to time the stock market. In 2025, the root cause of the chaos is the Trump administration, and as we continue to read the articles, it feels like the problem with the Trump administration is getting worse, and it's hard to predict where it will end. It's uncertain how long we will have to suffer because of the Trump administration. So even now, In order to protect the remaining investment funds, many investors are selling all their stocks and leaving the United States market today. That's why the current gift tax is so low. There seems to be a lot of investors who decide that they can't go on any longer, and because the tax issue is getting worse, they need to sell everything now to protect their investment funds. Investors familiar with United States stock market history understand this, correct? The bottom of this adjustment is likely to be found before the Trump tariff issue is resolved. The possibility is very high. And another thing, we already know from history that a rebound will start before the worst case scenario hits. So even if the situation continues to deteriorate in the end, stocks always move forward. Therefore, no one knows when it will hit rock bottom. It could be next week, it could be next month, and of course it could be in 3 months. Even though the situation is worsening, it doesn't necessarily mean the stock market will keep declining. We need to remember this part. Why? Because it won't be any different this time. The history of the United States stock market will repeat itself, and it would be good if we could have a little anticipation in this way. The content prepared for today is the outlook for today's United States stocks. So far, we've heard a lot of opinions from non-experts on United States stocks, but from now on, we'll try to listen to the opinion of one of the sharp experts, BlackRock's Reader. Let's see what kind of opinion Rick Reader, the extremely famous top investor of BlackRock, will present about the current situation and focus on his words. That's it for today's broadcast. Thank you for joining us for the last broadcast in March. And as I mentioned earlier, it seems like I will have to take a break from the broadcast tomorrow. On April 2nd, I will gather various information that can help your investment activities and come back to greet you. The situation is extremely difficult and continues. While the situation is tough, I hope you all take good care of your mental health and continue to invest healthily. We will all fight together until the day we retire as United States stock investors. Have a happy day. Thank you.
Here's another piece of monthly news. The trend continues into the last hour of trading day. Today's guest is Rick Reader, the top investor and portfolio manager at BlackRock. Rick, welcome. As mentioned earlier, while stocks are falling and bond yields are rising, there's not much change in the bond market's fixed income generation. What do you think about the recent tax-related headlines? And how do you feel about the market generally reacting sensitively when such headlines come out very quickly and intensely over the past few months?
You mentioned uncertainty. The market hates uncertainty. So as you know, I always observe that the market can do only one thing at a time. It's like discussing the weather and nothing else, and having to respond every moment. And as you know, a lot is happening economically. So I think there are a few things beyond the tariffs. And as you know, this is creating uncertainty. And the fact that the president of the finance department has a tendency to hold a slight transition period to suppress changes, it is unknown how much it will be in terms of economic impact. And there's one thing I'm paying very close attention to. If you look at the data today, the chief executive officer's confidence has dropped tremendously. The year began with optimism, which has since faded. However, a recovery is expected by year's end. The economy will be influenced by whether companies delay capital expenditures, mergers and acquisitions, and R&D spending. Also, consumer spending can have an impact, but since consumption is more dependent on disposable income rather than savings, ultimately consumption will increase again. However, we must be careful. The data for the next few months will give us a chance to see how the market responds. If you're a business chief executive officer or an investor, you might want to consider reducing the volatility of your beta and portfolio for a moment. We need to see how it unfolds, and it's in the detail. Including the time to trade in the market, the volatility ends abruptly. Not only on the day of the market, but also on Friday and early this week when the market rose sharply.
If you have a question about the self-funding you mentioned, I received the Carfax data in T-month today. But the core Carfax number showed a 0.3% decrease, which was an unexpected decrease. This is a big number in terms of volatility. You can see how much volatility this number has on the chart. It's a big number in terms of volatility. You can see how much volatility this number has on the chart.
If you actually track the past 2, 3 weeks, one of the reasons why the interest rate market couldn't back up the concrete data is that there are a few minor things. The hard data was quite good. It's sentimental. Institute for Supply Management survey, consumer confidence, unemployment rate. The survey was quite tough and the hard data was quite good. However, as you said, if people see the hard data that makes them worry a bit crumble, as you said, if people see the hard data that makes them worry a bit crumble, I don't think we're going to fall into a recession, but for the next few weeks, companies will be sitting on their hands. Everyone is waiting. So for the next few weeks, maybe for a few months, we won't get a lot of data to refute the recession theory. That's one of the reasons why we need to manage risk for the next few months. If other circumstances unfold, I think the economy is in a good state and service-oriented, and it will be even more stable in the future. However, I think everyone needs to be a little patient for the next few weeks.
Seeing the background of such volatility, we will carefully observe the economic data again and again. Perhaps we can see some buoyancy there. What does all this mean in the context of portfolio composition? As a stock investor, what should I be screening for?
So, first of all, everyone is trying to reduce beta, increase cash, and like I did today, add resilience to the portfolio. In the end, the market will rebound.
What does resilience mean?
I prefer to invest in opportunities that have potential for growth when the market is down. It's a good time to invest in such opportunities for future profits when people start to panic. One way to approach this is to build up cash in your portfolio, but you also need positioning for the upswing. People can be anxious because there is a high possibility that taxes will suddenly be imposed. However, once the data is released, people tend to avoid sensing the risk before the event occurs. Watching the news gives a sense of security despite the content, and money accumulates. So I'm meditating. Especially, I am buying the species with the potential to win in the bear market. Think about what's happening in the gold market today. The gold price is rising, and the Treasury has to issue a considerable amount of debt. Annual rates can't be adjusted due to high inflation. What's the solution? Gold is a good hedge, and cash is also a solid option. However, the best hedge is reducing exposure to assets with high volatility.
I want to ask another big question about the picture. The last time you and I sat down for a serious conversation was a few days after the election at a major investor conference. And the people we talked about there were generally very skeptical, talking about the new administration. CEOs were skeptical, and the business community was skeptical. And President Trump said this kind of gold rush is coming to America. Is that gold rush just a pipe dream now, or is that idea dead? The atmosphere now is completely different from the point we were talking about.
Even a few years ago, that was the feeling. In my experience, I don't think I've ever seen an animal's spirit move so quickly to another animal in the same species. Such things happened and are still happening now. So, Mr. President, in my opinion, the administration explained its intention to go through a transition period in order to move in a different direction. I believe that good things will happen eventually, but I think we need to have the will to transition. At the same time, Fed is not likely to put a lot of money into the economy from the perspective of lowering interest rates because of high inflation. So we are in that period. I think the cash, in other words, the money that companies have on hand, is going to be put to use from an investment perspective. It will just be delayed for a while. And I think people have to endure this uncertain period until they realize that the United States economy is going to be okay. If you run a major company like Ashita CP, there are national and international fluctuations, distribution channels, and M&A, but you have to wait for a while. So don't think it disappeared. Just think it's still there in its original state. What advice would you give to the current investors who are mourning the loss? If it were me, I would invest in gold. When considering the annual perspective, it doesn't seem like the interest rate will move any further. However, you can still make profits in the portfolio. For example, we have an exchange-traded fund called BNKT, where the cash inflow is still strong. Through this, we can create a portfolio that yields about 65% return, and we can construct the portfolio at that return rate without going too far off the profit curve. Many companies have refinanced their debt after the corona using a lot of coupons, so the credit quality is stronger than ever. I will focus on stable profits. Think about whether you can make a profit rate of 65% and profit this year. In times like now, when the stock market is volatile, stable income is attractive. Because we had to buy high-yield assets at only 35% for several years, I think it's a golden age now. Now that the annual rate can't lower the interest rate, and because the European Central Bank will move more, we can buy assets. Income and stability are not very attractive, but they are quite powerful.
And when considering the prospects for the United States economic situation, will it look even more attractive? This is what we talked about in the past. As the tax issue progresses, it is natural that all tax issues will increase the financial resources of the United States. Today at the forecast meeting, we learned that the finance department basically has to resolve the deficit until August or September when the money runs out. Other negotiations are also underway.
You pointed out the biggest problem. The debt is too much, and the amount of debt we have to pay off is also too large. What the government wants to do is reduce spending and control debt. Sometimes we have to ask for help to get there, and we have to compromise a bit. I really don't like it, but in the long run, it will help. So I think we should focus on revenue now. It's good to maintain a stable state for the time being. This drastically makes a better result from the other side. However, the biggest risk is not just the bankruptcy itself, but the enormous cost involved in recovering from bankruptcy. The debt repayment amount continues to increase because the interest rate cannot be lowered. So we know we have to solve this problem. I want to support that intention. When you first start talking with civil servants, such as the Ministry of Finance or the Assembly, you realize it's like casting a fantasy character.
I will keep an eye on it. I will check again how the market responds at that time. Thank you for being with me.
Thank you.